welcome to our first panel. The only problem with those very high-tech introductions is that I couldn't actually see how our panelists were being introduced, but you now know more about them than I do. The first session today we've called the global economy the turnaround, which I think is optimistic, but the big question is the global economy set to accelerate? If you look at most forecasts, they do have faster growth for 2014 than 2013. And I think we're going to set the stage for the discussion over the next couple of days to sort of probe where the growth is going to come from, how confident we can be about that growth, and whether policymakers are doing all that they can to support it. And Minouche, if I may say, Nemat Shafik is known universally to friends and colleagues as Minouche, which is why I'm calling her Minouche. Minouche, may I start with you, since you are from the fund, and the fund came out with its latest World Economic Outlook projections just a couple of weeks ago, where you do, I think, have global growth accelerating next year to 3.6%, and it's basically because of an acceleration in the US. Maybe you set the stage a bit by telling us, why you see this acceleration in the US and where you see the rest of the world going.
Okay. We do, in fact, actually have a reduction of our growth estimate for 2013 down to 2.9%, but then in 2014 it goes up to 3.6%. The reduction this year is actually driven by the actually rather sharp reduction in growth in the emerging markets, particularly India, but also Brazil and Russia, where we revise our growth forecasts downward. But in 2014, we are predicting a recovery. What we're seeing, actually, is the last 5 years have been dominated by the story of the emerging markets are driving global growth. And what we're seeing now is a sort of handover from the emerging markets being the big drivers to the advanced economies, in large part because of the US, but also because we're seeing some signs of recovery in Europe, and also Japan is doing pretty well. So the composition of global growth has shifted in favor of advanced economies.
That depends on this acceleration occurring in the US. We'll get to the euro area in a second, but Bob Rubin, it seems to me like waiting for an acceleration in the US has been a bit like waiting for Godot. It's kind of, it just hasn't happened yet. Is next year going to be any different? And in the context of that, how much damage was done by the recent debacle in Washington?
Okay. Waiting for Godot, by the way, opened in Miami 30 years ago with terrible reviews. I don't know what relationship that has to this, but in any event. Look, I think most analysts would have a projection similar to yours with respect to the United States. You all, if I remember correctly, predicted next year, or projecting next year, 2.6% for the US. A lot of analysts projecting somewhat higher, more toward 3%. I have a somewhat different view. I think that's certainly possible. It may even be the most likely, though it's not my view. But I think if you look at the four underlying areas of demand in any economy, which is government, consumption, net export, and investment, both residential and business, I don't think that the areas of demand, at least on current facts, support the view that we'd have that kind of growth. Now, those facts could change, obviously. So I think that there are enormous uncertainties, Zanny, and my own feeling is those are not the most probable numbers, but even if they are the most probable, I think there are very, very substantial uncertainties and a very realistic possibility that growth in the US could fall meaningfully short of the IMF number.
And just to press you on that, the IMF says 2.6, meaningfully short of that. Would that be because the private sector recovery was less strong than is being predicted, or would it be because there'd be more of a hit on the government side than you expected?
No, I was thinking more, if you take a look at consumption, Zanny, if you have 160,000 jobs a month, that's still a growth rate of well under 3%. In fact, I think it's closer to 2%, if I remember the numbers correctly, in the labor force. And then if you have average wages being just slightly up, your labor income is only going up 2 plus a small percentage, whatever that is. So you've got to bet, at least on the consumption side, which is 70% or thereabouts of the economy, of the savings rate coming down. The savings rate's already quite low. Now, all these things could change. Average wages go up, but I'm just saying on current facts, consumption looks like it would lead you to a considerably lower number. And then in business investment, at least at the moment, it continues to be very slow. Housing is better, but it's slowed down a little bit now. But because the base was so small, it's not a large percentage of GDP. And net exports, since I don't think that the world is going to look so terrific, it doesn't seem to me that that's going to be a driver. It's also a pretty small percentage of the U.S. economy.
Minouche.
Yeah, no, I think a key assumption of our projections is that the U.S. fiscal situation improves. I mean, fiscal policy in the U.S. has been highly contractionary this year because of the sequester. It's a terrible way to do fiscal consolidation because it's indiscriminate. But the worst of the fiscal consolidation in the US as well as in Europe will actually decline this year. So in 2013, so that is behind us. And so at least we'll get a bit more demand from fiscal policy than we've seen this year going forward.
Do you have, and I'm going to get on to Europe in just a second, but you came out with these projections actually during the government shutdown. And so presumably, unless you're even more prescient than people think the fund is, you have had to make some assumptions about where that was going to go. Right. If you were redoing them now, or if your economists were redoing them now, what kind of a hit are you assuming, ongoing hit, will there be from what's happened in Washington?
I mean, I think like most analysts, our estimates were that the shutdown itself had a very small impact, 0.3% of GDP in the fourth quarter, not anything significant. Our projections do assume that the shutdown will not occur again and that there will be a budget deal. And our projections also assume that the Fed will keep interest rates low until about 2016. So those are the underlying assumptions of this U.S. recovery.
What kind of budget deal are you assuming?
We don't go into the gory details, but we assume that...
They assume sensible fiscal policy.
They
assume sensible fiscal policy.
Well, I assume a lot of things in life, but they don't turn out to be right.
That's right. We assume that there won't be, that the debt ceiling will be raised, and they won't have another shutdown. So those are the two key assumptions.
Let's move to Europe. I think it's probably fair to say that historically, the fund, along with most others, has been more optimistic about the prospects for a U.S. recovery than has actually turned out to be the case in the past few years.
Actually, if you look at the last three, is this mic working? Okay. If you look at the last three forecasts of the IMF, and that I'm about to say doesn't say anything about the future, but they have lowered their projections each of the last three times. That doesn't mean that they're going back up. It's just an observation. You're right. The fiscal drag
and
shouldn't.
not just the IMF, to be fair. I mean, that's
true.
That's
no, I think no.
True.
Well, that's the point I was going to make. That in the last 3 or 4 years, toward the first half of the year, projections for the U.S. have been better, and then they've been disappointed. And that's just been the way it's been. Doesn't mean it's going to be that way in the future.
Let's turn to another part of the world where I would say that for the last few years, expectations have been very grim and have even then consistently disappointed, which is the euro area, where, finally, in the second quarter, the euro area emerges from recession. I can't remember the IMF's exact forecast. I think it's 1% next year. But the question to me seems to be, is the euro area simply going to stagnate? Or are there actually the ingredients there for a stronger kind of recovery? And whenever I talk to people from continental Europe, there seems to be a remarkable optimism that, it's over, we finished the crisis, everything's going to be fine. And whenever you talk to people outside of Europe, there's a deep sense of skepticism and a sense that maybe, okay, things aren't shrinking, but it's not looking so great either. So what's your view?
Well, you could guess. But I think after pulling back from the brink, you should not be surprised at this sentiment of relative optimism. I'm relatively optimistic going forward, and this could mean that the projections could be wrong by being too conservative. If things go as they have been going since June 2012, meaning the roadmap of the banking union, fulfilling all the main milestones in the continental European style. So until the very last minute, you don't know whether the agreement is there, but it will be there. And why so? I think, for once, the political commitment, I think, was made in earnest, even if there are some mishaps like the Cypriot saga that could put into doubt the awareness of some of the politicians that signed up to the banking union, but also due to the role of the ECB in all this. The ECB is taking, I think, a lot of risk in trying to make this a success, including taking on its shoulders responsibilities which are very serious going forward. It's been not just macro-prudential supervisor, but also micro-prudential supervisor for the banks in the Eurozone. And I think in the case that political fatigue or political backlash would again threat the environment, I'm sure that the ECB would play ball again, pushing politicians to agree in order that they fulfill the commitments that they have made.
Yes, go ahead. No, go ahead.
I just make one observation, if I may. The finance minister of Spain the other day was quoted as saying, this is paraphrase, is not exact, but it's pretty close, that the recession is over, but the crisis continues. Mm-hmm. And I guess that would sort of represent my view. The banking union, if it were to happen, would be wonderful. And I don't know which proposal this is now. It's the second, the third, the fourth, whatever it is, it keeps getting proposed and then keeps getting deferred. So I think one would have to at least be slightly skeptical about the probability of this happening. There had been a wonderful proposal, it was a couple of years ago, I've forgotten, when the ESM was going to provide the capital to make this all happen. There was going to be no contingent liability for the sovereigns. Then that eventually got whittled back to the point where it was dropped. Now we have a new proposal, and I believe this proposal is supposed to end, I may be wrong about this, but it's supposed to be materialized or be effectuated somewhere toward the end of 2014, if I remember correctly. So you may be right, and I hope you're right, because it's very important, but at least if past is prelude, one would have to at least be slightly concerned.
Can I just actually add to that? Yes, of course. But I'm going to just add to the comment that Bob Rubin made, which is, if you are parsing the reasons for the recovery right now, I mean, at some point, recessions tend to end. So it could just be that recessions eventually come to an end. It could also be that there's been actually a change in macro policy, particularly fiscal policy in Europe. And Manouche mentioned that in the case of the US. Is it simply that, the periphery economies are no longer beating their economies to death with too much fiscal tightening? Or is it the broader, banking union and positive approach to sort of structural and architectural reforms that you're discussing?
It is a combination of both, because the pace of consolidation has significantly diminished. Perhaps not to the extent that the IMF would advise, but has diminished very clearly. But what I see is, if you look at the financial sector, you see the most weak or the weakest part of the financial sector in peripheral Europe have been submitted to deep reform and recapitalization. Spreads now in the markets are quite lower than they were 1 year ago. The markets indeed are not open yet for many institutions. They are open for the big players, but not for the main institutions, which means that we have a fragmented financial market. So the proof of the cake will be when this fragmentation disappears. But this is a slow process. So now you have the Capital Requirements Directive entering in force in January. The single supervisor will be live at the beginning of November this year, preparing to take over the responsibility, which reasonably takes at least 1 year, which is the timing that they will take. And in the meantime, asset quality reviews and stress tests will be done. There is a proposal that will be discussed in December, so you have a lot of milestones to test whether your skepticism is granted or not. Because in December, the Council of Europe will discuss the proposal of the Commission on resolution, a single resolution mechanism, how to go about this. So the last piece that is needed for the banking union to function would be some kind of system of deposit insurance. But this would come at the very end if you believe in the resolution agreements, whereby depositors are super senior to anybody else.
Do you think, and I'm also going to ask Manouche this, do you think that is enough to create the conditions for a more vigorous recovery in Europe? Or are we really looking at, basically a sort of Japan-like situation where the economy, grows a tiny bit, but essentially it's in a very low inflation, low growth, stagnant equilibrium?
I mean, there is a scenario like that. There is a scenario where there's reform fatigue in Europe.
you're a journalist. But no, I'm saying there's something more than de minimis probability that there could be destabilization, but not a large probability.
Let's just turn I want to get on to central banks in a second, but just to the other part of the world, and we're not going to go on our tour everywhere, but let's look at the emerging economies, because for the past few years and at previous Buttonwoods, the great hope has been faster growth in the emerging economies, a rebalancing of global growth towards the emerging economies. And the big story of this year, and in fact the end of last year too, is the slowing of the emerging economies. I think it's 80% of emerging economies are now growing slower than they were a year ago. Minouche, is that a cyclical downturn, or is it a secular downturn, and do we need to get used to a world where the EMs are no longer the great hope for global growth?
Yeah. Well, the answer to is it cyclical or structural is it's both, and it varies by country. So we've done some analysis which shows that for countries like India and China, the slowdown we're observing is structural, whereas for countries like Russia or South Africa, it's cyclical. And of course, the policy consequences are different in each case. In the cyclical cases, it's the classic use fiscal and monetary policy. In India and China, it's about structural reforms, which mean that potential growth in those economies is lower, and so we need to invest in potential growth. Do we need to get used to a world in which the emerging markets are not the growth engines? I mean, first, they are growing more slowly. I mean, emerging markets are growing 3% lower today than they were in 2010, so that's a relatively big slowdown. But having said that, they're still growing much, much faster than the advanced economies, and they're going to continue to grow much faster than the advanced economies. I think it's important to remember that, in a crisis, we all fall together. But it's normal that countries are at different stages of the business cycle at different times. People got very excited about decoupling a while back. Decoupling is normal. That's normal. It's only when you have a really severe crisis that everyone falls together. And I think we're going into that more normal stage where different countries are at different stages of the cycle.
But it does make a difference for the outlook, to tie this back to the advanced world, particularly, say, for Europe, where, to the extent that we've seen, the expectation was that growth would come in part from net exports. And the euro area has shifted very much to a current account surplus now, and a big part of this rebalancing and transformation in Europe was reliant on demand growth elsewhere in the rest of the world. Now, some of it may be from the US, if Bob Rubin is wrong and you're right about the prospects for the US. But if the EM world is a slower growing world, doesn't that then bode badly for Europe's recovery?
I think the slowdown that we're talking about is modest by our standards. We are talking about 0.5 point of GDP, right?
I mean, China's still growing at 7.5%.
7.5, so I mean, this is not
the double-digit rates of 2-3 years
10.
ago.
Yeah.
Okay. But I think this does not move the situation. And on the other hand, you have a lot of internal demand, which is now repressed due to uncertainty in Europe that could be that could increase also on the back of improved sentiment that you see, in particular in the peripheral countries, the worst hit by the crisis. And you see that now. So improved sentiment, you see investment picking up in countries like Spain, for instance, real investment, machinery, and this is preceding employment creation. So it's the standard cyclical recovery where you have exports first, but then you have internal demand, investment, machinery, and then employment. And don't forget that many of these countries have undergone deep labor reforms. And this means what it means. It means now completely liberalized labor markets with a lot of scope to change wage and other employment conditions. And this is pretty different from previous crises where massive employment destruction could not be easily assimilated because the job market remained rigid.
So does that mean you're looking for a sort of traditional V-shaped recovery in the peripheral economies?
Yeah.
Yeah? You're raising your eyebrows.
Yeah, I think it'll be a V, but I think it'll be a V turned this way. These will be the hopes and these will be the realities. But look, what the heck do I know? But an awful lot of people who do business in Europe who don't think the labor markets have been anything like reformed to the extent that they need to be. Now, time will tell, and we'll see what happens. But I don't remember the number, Minouche, but the last quarter in Spain, which we're all so excited about because they've grown, was that 0.1%? Yeah. So 0.1% is not exactly what I'd call a buoyant recovery. I mean, this is, I wouldn't break out the champagne quite yet, I think.
The one, you mentioned earlier that a lot of this depended, in your view, on markets' belief in what Mario Draghi had said. I just want to turn that into a broader question about central banks, because there seems to, the world economy is still enormously reliant on central bank looseness, central banks propping up the recovery with very, very loose monetary policy. In your view, is that going to continue, and is it a good thing, Bob?
You know, you made somebody made, I think it was you, Sandy, made a good comment before, and this has been true for a couple of years or three, maybe through this whole European crisis. There's always been much more skepticism on this side of the Atlantic than the other side of the Atlantic. So far, this side of the Atlantic's been right, but at some point, maybe the other side of the Atlantic will be right. I don't happen to think we're at that point now, but maybe we are. No, I think this central bank situation, this is a complicated question, and we have a short period of time, but let me just sort of give you 2 or 3 sentences that are my view. I think Mario Draghi is outstandingly capable. They were extraordinarily fortunate to get him to be head of the ECB. But but the ECB, by its own actions, cannot do anything, zero, to deal with the growth crisis, the fiscal crisis. Well, the growth crisis is it's a little more complicated, but the fiscal crisis or the banking crisis. You've got to have policy action. And if you have my view, which may not be a correct view, but it's my view, that the political leaders are still way behind the curve on all aspects of policy, then what the ECB is doing is buying time, which is a valuable thing if it's well used. But at the end of the day, the ECB can't continue buying assets. Now, the OMT hasn't even been implemented yet, obviously. But even if they decide they were going to go into the markets and buy and buy and buy, there's a limit to how much of that you can do, and ultimately you're going to run into the equivalent of capital flight and a destabilization of markets. So it all comes back to the question, will the political leaders do what they need to do? And there, time will tell whether they are or they are not. I'm skeptical myself.
And before I go to the other 2 panelists, the same question in the context of the U.S.
Could you comment on the Fed?
Yes, exactly. That's what I want. Exactly. The Fed. I want your view on what the Fed is doing and whether what the Fed is doing is.
Let me see if I can put this in a way that I'm comfortable with.
I'll translate.
Yeah, I'm not worried about your translation. I'm worried about your mistranslation. QE1 was absolutely essential. I think with QE3, the theory of the case seems to be that we have very high unemployment and we have very slow growth, and therefore the Fed has to do something. I totally agree that the unemployment rate and the growth rate are terrible problems, but the test for what the Fed should do, in my opinion, but I think this is sort of unarguable, is a risk-reward test. They should only do that which is favorable on a risk-reward basis. Most economists will say, I believe, that QE3 has had relatively limited effect on the beneficial side. And then the question is, what are the risks? And I think that there are real and serious risks. The tapering isn't the problem. I mean, the tapering creates problems every time they talk about it. And why the markets are surprised that sooner or later you're going to have tapering, I don't know. I mean, obviously you're going to have tapering. But it's the unwinding. Monetary policy always involves large uncertainties. And here, you're going to be unwinding a position that is vastly greater than has ever existed before in terms of balance sheet and what we'll loosely speaking call money supply. It's monetary base, obviously, at the present time, money supply. And so the uncertainties presumably are that much greater. And then I'll just finish one more sentence, which is that they don't have to sell bonds. They can increase interest rates, as we all know, on the excess reserves at the Fed. But no one knows what it would mean to have to increase interest rates on this magnitude of excess reserves and how that's going to work or what effects it'll have through the economy. So all I would say, Zanny, is it seems to me that the risks are meaningful.
But just to clarify, to make sure I understand, given where the rest of U.S. policymaking is, you think the U.S. economy would be in a better place if the Fed were not doing what it's doing?
I don't think, I think it is a widely held view that if the Fed were not doing what it was doing, there probably would be relatively little difference right now. But I think that I think the problem is that the risks that I've just begun to allude to, though the timing is absolutely unpredictable, are at least in my view, serious and real in terms of the probabilities of their happening and the consequences they do happen, but that's someplace out in time, and I think an unpredictable point out in time.
Give me, now you get the chance to comment on the Fed as well as the ECB.
But I would like first to clarify on things that were said about the ECB. You see, the strength of the ECB in all this game comes from the fact that on top of having Mario Draghi now and Jean-Claude Trichet before, both outstanding in their own ways, It is the fact that this is the only federal institution in Europe, the only institution with a federal mandate. And they have behaved in a way that they are, I think, fulfilling. Can they do anything to improve the fiscal situation? The answer is no, with a nuance, because when the ECB speaks loud on which situation is good or bad, this could have an impact on the market perception. Can they do anything on the side of growth? I think so. And this is part of the mandate of the ECB. They should have a policy which is right in line with the price stability mandate. And indeed, I think Draghi has been very clear, saying he's not satisfied with the level of inflation he's observing now, which is closer to 1 than to 2. And this is why forward guidance is there and expectations for low rates for long are there. And I think the ECB has tools enough to keep that promise. And finally, on the banking side, can they do anything to improve the situation? I think clearly yes. Up to now has been difficult because they have provided a lot of liquidity for the sake of keeping the euro as a single currency, but they did not have in their hands the supervision, so the capacity to avoid forbearance that you see in every corner. Mm-hmm. But now it will come on under the responsibility of the ECB to avoid that this happens. So I think on all these counts, the ECB remains crucial, perhaps more crucial than it would be advisable, because the risks they are taking are immense.
Just before I ask Minouche the same question, can I just make sure I understand? Should the ECB be doing more, though? You say that inflation is well below its target. You know, as a former central banker, if you were there now, would you be pushing for more action, more aggressive policy action? You.
Are you asking me?
Yes, I'm asking you.
Yes. No, of course. I think the ECB is doing at the moment the right thing. It's a combination of low rates, not at 0, but 0.5. I think the situation now is not a matter of rates, although there is some room there because they are studying ways to, including have negative rates on the deposit facility and other means. But they could do a lot of things, kind of having additional long-term refinancing operations with no indexing in the rates, which would anchor expectations for a long period of time. There's plenty, I think, plenty of capacity. Would I be more aggressive? Frankly, I'm sure that my former colleagues are not satisfied with the expectation that inflation would be 1 or 2 years off, around 1%, slightly above 1%. And this is calling for some kind of action at some point.
More action. Minouche, I think the IMF has been calling, certainly for the ECB to do more, and you've been broadly agreeing with what the Fed has been doing. I mean, how would you react to Bob Rubin's skepticism of what the Fed's doing?
I mean, I think we have been supportive of what the Fed has done, and I think we think the problem is more on the fiscal side, because as you said, monetary policy just buys you time, and the question is it being used well? And the fact is, it hasn't been used well, because fiscal policy is doing the opposite of what it should be doing, which is being accommodating. I mean, fiscal policy at the moment in the US is contractionary in the short run, and hasn't done anything to deal with the serious medium-term issues. And it should be doing the exact opposite, that US fiscal policy should be accommodating in the short run to support the recovery of the economy and dealing with the very serious medium-term issues around entitlements. So, I think the Fed must be very frustrated because the time it has bought has been misused by policymakers on the fiscal side.
One sentence comment. I totally agree with everything Minouche said. What's so sad about it is that there really is a program out there that could do exactly what you said. What I'm about to say is not a political comment, it's a substantive comment. President Obama proposed a year or thereabouts ago, I don't remember, that the sequester be revoked, that instead there be a program with Social Security and Medicare, the beginnings of reform, some additional revenues, a deferral of the implementation, an act now but defer later, and a modest upfront stimulus. If you did that, it would accomplish all the purpose that Minouche said, including putting in place a serious fiscal program, and I think it would have a tremendous effect on confidence. But our political system simply isn't functioning.
I'm going to open the floor to questions in just a second, but before I do that, I want to ask each of you, and it leads on directly from that. When tomorrow's history books are written, what kind of a grade are historians going to give today's policymakers in Europe and in the US? Let's focus on those two. And which ones will get the higher grade? Bob.
Why don't we start with somebody else?
You have to be the tough grader.
Yeah, you
No,
can set the, we can have grade inflation
Well,
here,
we
and you can
obviously,
set the
look,
standard.
we obviously have a dysfunctional political system in the United States, and the future of our country depends on it recovering sufficient ability to deal with our challenges. I personally believe that will happen because we've had a resilient system all of our history. We've had other difficult periods. We have a dynamic society, but the path back is certainly not clear at the present time. I think the Eurozone leaders have been behind the curve from the very beginning. I think they're behind the curve now, and I don't think that there's much credit to be given there. So that's my
So
view.
sort of pox on both their houses, both get bad grades. Jose Manuel,
I think the grades would have been different depending on the moment of the crisis. You have graded politicians. At this very moment, if you split between politicians and central bankers, I would say consistently central bankers get a higher grade than politicians all along.
I doubt many people would disagree with that. Yeah. But within on the political side, do you think, many in Europe look at the US and think this is a much more dysfunctional place than Europe, and I think in the US, lots of people still think Europe is.
I think up to the moment when this was a normal crisis, I think politicians didn't do things that badly. And I would say up to the beginning of 2010, I think more or less in Europe reacted also well, coordinating policies, expanding fiscal policy, agreeing on common action at the level of heads of state and government. I remember at the end of 2008, this was a premiere. So they were, I think, responding not optimally, but in line with expectations. But after 2010, mid-2010, they've not been brilliant, I would say. Not been brilliant, until June 2012. I think in June, by chance or not, they decided the right thing to keep the Eurozone united. And since then, I think steps have been given in line with the regular difficulties that you always see in Europe, but they have been progressing.
So they're doing better now. Minouche, briefly, you're in the business of grading countries.
Thank God we don't give them grades. But I think just after the crisis, I think policymakers got an A for 2009 because we actually had signs of a recovery in 2010, if you remember. 2010 was kind of a good year for the world economy. But then the more difficult long-term problems were not addressed. What I think is interesting is that the metaphor, the journalistic headline that everybody uses to describe how policymakers performed in Europe for 2011 and 12 is they're kicking the can down the road. Now, for 2013, that's what's being described, how US policymakers are being described. They're kicking the can down the road on US fiscal policy. And so I guess my view on the student did very well and has been slacking off and not doing its homework since then.
Could try harder, isn't that what it
Could
says
try
at the end?
harder, not good effort.
Thank you.
And it's a failure of governance in both sides of
Let's
the
open the
Atlantic.
floor to questions. There are people coming around with microphones, so if you could just wave your hands, hopefully I can see you without my glasses on. Yes, gentleman there, halfway back, in the middle. My glasses.
Thank you very much for a very insightful panel. Bal Das from BGD Holdings. A question that I have for the panel is, it seems to me, in terms of a global turnaround, one key underlying theme is the changing dynamics of a global, at a global level of demography in a critically interlinked and interdependent world. And is there a sufficient enough appreciation in the policy and in the economic dialogue, other than anecdotally, when you're looking at the debate, fiscal, monetary, about the relevance of this? This is structural. This is not something you can change in a couple of years' time. I appreciate your thoughts on that. Thank you.
That's a very good question. Do policymakers focus enough on, think enough about the impact of demographics? Who'd like to, Bob, why don't you start?
I think with problems, we have a dysfunctional political system, but if you're talking about policy discussions in the United States and the policy dialogue, I think people are very aware of the demographics. And the United States actually has pretty good demographics, at least looking forward, certainly good relative to the Eurozone and good relative to China and good relative to Japan. But I think there's a real consciousness of of demographics in the policy dialogue. The trouble is none of this translates into action or activity because our political system is dysfunctional.
Although arguably, correct me if I'm wrong, Jose Manuel, the Europeans have done much more to deal with their demographic challenges than the US has. In
What
the
have they
sense
done?
that, well, pension reforms and so forth have gone much further in many countries in Europe.
Yeah, but in other respects, I would agree with more skeptics on this one, because you can see, for instance, Germany. In German demographics is catastrophic, and Germany is surviving because they are accepting skilled labor that is fleeing the crisis countries. But this gives what it gives. For 10 years, 15 years, you have enough gas, but let's see long term. And there is a deep-seated resistance in some societies in Europe to accept immigration. You have anti-immigration parties in some countries, like Holland, Greece also, including Greece. And this is not the case in Spain, but yes, in other countries, so limitations to immigration act as a constraint in order to get more vibrant demography in Europe.
Well, and just the other thing that many countries have neglected is female labor force participation, which could help pension schemes become much more viable. Countries like Japan, Italy, Spain have very low levels of female labor force participation, and that demographic shift would make lots of macroeconomics much easier.
Another question? I can't believe there's no more questions. I have loads of my own if there aren't. There's a gentleman there who's sort of half got his hand up, yes.
I'm curious why the IMF is so supportive of quantitative easing, presumably in an environment where asset prices are above their long-term equilibrium multiples and where the absolute level of yield, even for high-yield instruments, is below the nominal growth rate of the economy. Incentivizing further growth in asset prices risks bubbles and negative consequence. Furthermore, the IMF has talked a lot about savings investment imbalance in the US over time. Yet does not the quantitative easing disincentivize savings and by trying to inflate asset prices, try to incentivize investment spending, does this not contribute to accentuating the imbalances that got us here in the first place?
Okay. What you said is true from a long-term point of view, but from a we're in a crisis and we need to stimulate demand point of view, I think that's where our support of quantitative easing has come from. But it's not a panacea, and as everyone knows, monetary policy only brings demand forward. It can't create output from nowhere, and so unless it's accompanied by fiscal and structural reforms, it won't achieve anything. And I think part of the problem we're seeing in some countries is you've had the easing without the accompanying fiscal and structural reforms, which would have generated a genuine recovery. So,
can I push back on that a little bit, perhaps with the context of Japan? I mean, Japan, which we haven't talked about, it seems to be suggesting that actually you can do a heck of a lot if you have a meaningful push towards macroeconomic stimulus with an appropriate change in monetary expectations. And that maybe that's for 20 years they really did not very much. Now in the last year or so, there's been this very big push with Abenomics, and it does seem to have turned things around. I mean, is there a sense in which maybe even bolder monetary policy might be the answer?
I mean, you can always generate growth by, printing lots of money and spending a lot of fiscal policy, but you can only generate growth for a short time. It's not sustainable, and I think that's why Abenomics, all the commentary on Abenomics is, there are three arrows, and they've done the easy 1.5. They've done the monetary, and they've done the fiscal stimulus, but now they have to do the medium-term fiscal consolidation and the structural, and those are the hard bits, and so you can't sustain this without the hard bits.
We have a question that's come through from the live stream, which is sort of related to this, which is, what about staggering inequalities in wage earners' paychecks and CEOs' pay? Interest rates won't fix this. Bob Rubin.
Yeah, no, we do have an enormous problem in this country, but also around the globe, although the circumstances are different country to country. China has it too, but it's an inequality problem. Well, there's this little sliver at the top. The question is what to do about it. A lot of it is a function of technology and globalization, and those are also the forces that are driving growth. And so the question in that context is, what do you do about it? I totally agree that it's an enormous problem. And it's not just inequality, but it's also stagnation of median real wages. And that can affect not only is it a tremendous social problem, But there's an argument to be made, and I've heard both sides of this, but there's an argument to be made that if you believe in the long-term economy of the United States, I do. I actually have although very concerned about the shorter term, I think the United States has tremendous potential for succeeding if our political system could get at least moderately okay. But there is an interesting question, will there be sufficient demand if we have this enormous inequality? Some people say that because of the propensity to consume, there will not. And other people, and I've seen serious studies to this effect, say that the distribution will not affect demand.
That leads me to the final question I want to ask each of you in a 20-second answer, which is, we've been around the world, we've talked a little bit about monetary policy. Fast forward, and I know with Bob Rubin you have to give an exact date, so fast forward kind of 3 years. Which part of the world is going to be the biggest upside surprise? Not necessarily the fastest growing, but where are you going to be most surprised about?
I would personally, if I were looking to the long term, 5 to 10 years and then beyond, well, that's my reframing of your question. I would invest in the United States. Dynamic society with all kinds of advantages, and I believe that sooner or later our political system will begin functioning again.
Minouche.
I'm sure I'm not allowed to answer that question.
We're among friends. It's fine. I'll give you some time. Jose Manuel, you
All
answer
right,
it
give
and
me
then
a
you can
minute.
come back to Minouche.
I'm pretty sure that there is a notion that Europe is part of the past, but don't believe your impressions. I think in Europe you still have skills. You have more flexible labor markets than before, investment in education, and real drive. So I think you would see surprises in parts of Europe, in particular those most heavily damaged by the crisis at the moment.
Thank you. Minouche.
I mean, I'm going to give an unconventional. The low-income countries have done remarkably well throughout this crisis, and they've been incredibly resilient, and they've got much better policies. The frontier markets that are probably more on people's radar screens are more tied in with international capital markets and are actually a bit more vulnerable. But the low-income countries have actually had a remarkably good, solid 5% growth for the last 5 years, and we think that's likely to continue. So
Well,
there's a surprise.
that gives us some food for thought. The former Treasury Secretary says the US, the former ECB board member says Europe, and the IMF representative says low-income countries. Thank you very much. Thank you. I stay here. You can just, I have to stay here to interrogate some